For that and the rest of the playbook, let's bring in Stephen Wieting, CIO Group's Chief Investment Strategist, joining me here on set. It's good to have you. Welcome.
Thank you for having me.
All right. Why are you still long tech?
Well, how about earnings up double digits? It's been for the last few years. And when you take a look at next year's estimates, you can see expectations for revenue growth to continue, but to slow down. And I think the best analogy we have for this period, and none of them are perfect, the late 1990s period, remembering that 96, 97, 98, there were all sorts of warnings. This is over, the collapse is in, and we hear a lot of that again. I do think that we need to look at all these asset classes as a mature bull market. The S&P is trading at 27 times trailing earnings. But I think that the economy is actually poised to improve in the coming year. That's not going to get us necessarily the same types of returns that we have. Again, it's next year's earnings really will matter in the year after that. But these parts of the economy are growing now at a very rapid pace, and I think the rest of the economy has got some room to improve and to catch up.
Yeah, and that's exactly where I want to go with you. What do you think drives that improvement in the economy? How much of this is AI infrastructure? How much of this is something else? Well,
a lot of the strength in AI infrastructure is sort of out on its own. 42% growth, the most rapid growth rate since the personal computer was invented. But the rest of the economy has been held back. Construction has contracted. Industrial production in the United States has grown only 1%. You haven't seen manufacturing employment increase since March. But you take a look at that and you see consumer spending has grown 3.5% as of mid-quarter 3Q when the data were turned off. So there's been a lot of business caution. You can see it in 9 out of 10 industries in the ISM report are really concerned about tariffs. So we've taken a lot of hits across the world economy this year. If we stabilize in terms of macro policies, including trade, we'll see in the coming year producers will raise output a little bit faster to the demand pace.
Cracks in the credit market scenario right now, you see that as an early indicator of something bigger, broader here?
Well, the longer we get into a recovery, the issues of easing credit standards will matter. As we just wrote in our CIO Group outlook for 2026, we would not be investors in regional banks. We wouldn't be investors in the auto industry, right where you're seeing all of these issues. But let's bear in mind that a couple $2 billion of fraud is not exactly indicative of what's happened across the entire economy. I think that the worry that we've had about all of this, again, it very much tells you something about sentiment, that there are a lot of people who are still worried on the sidelines and thinking that it's all over. And that goes right back to repeating the pattern that we saw in the late 1990s before it became really excessive.
And we have the Fed in a blackout period right now. There is a large, we'll say, as close to certain as you can get in the market right now, pricing in an expectation of another Fed cut here in the coming days, coming weeks. How much of this hinges on that actually happening? And perhaps just as importantly, because I don't know that we've been talking about it as much as we should, the slowdown in the runoff of the balance sheet for the Fed as well.
Sure. Well, a couple points on that. When the Fed is cut more than 100 basis points, it's usually not good for the economy markets, the conditions that drive it. Now, there have been some exceptions. Again, the mid-1990s is a pretty good example. Again, didn't quite get to 100 basis points. But the bottom line are just recalibrating a bit, focusing in on the labor market, which has slowed gains to a crawl, and looking at that very differently from corporate profits, where we're going to get a lot of beats, and we're expecting in the coming year more than 10% EPS growth. So I don't think it really depends on the Federal Reserve cutting if they had strong reason to. If, all of the AI spending and the rest of the economy were going south, it would be a negative regardless of the cuts. Now, in terms of the balance sheet and that other question, I would just bear in mind that, the Federal Reserve has done a better job than it did in 2019. It was borrowing and lending at the same time. It's cut its securities holdings by over $2 trillion. And it's, again, I think can really been a little bit lucky here that the economy is normalizing a lot of the noise. We've had higher inflation rate than we otherwise would, but it's going to come down some in the coming year.